of all, thanks everyone for taking the time to come and join us today. The topic of my presentation is going to be fairly generic and general, but I think given the macroeconomic outlook that we are faced with, it would be a perfect subject to talk about given what we saw last month, especially with our lovely government and everything that took place. A lot of people are kind of wondering, so where are we going from here, not just domestically, but on a global basis? And also a lot of the concerns as to where would be a good place to hide. Historically, whenever investors would get nervous about the overall market, whether it was real estate market or equity market, everybody will go into the bonds. And now we're seeing that the worst place to go is in the bond market right now. They would be going from frying pan to jumping into the fire. A lot of the risk that we used to look at in the past are changed in a way that we have to be very conscientious of the bigger picture, not just what's happening in the backyard and what's going on with the specific companies in the United States, but on a global basis. Many of the companies that historically have been the safest stocks to buy their bonds or buy their stocks are now changing due to the fact that majority of their income is generated from global markets and coming from emerging markets. I'm not going to go through each one of the pages or the slides. I'll let you guys read through it. But many of the pages and information that we put together for you is just basically focusing and talking about how globalization has changed the big picture in a drastic way. And even with the emerging markets that for several years was in favor and everybody felt that majority of the growth was coming from emerging markets, that has also changed. Moving forward, we're going to be seeing some smaller countries that are going to provide a better risk reward compared to some of the larger markets. Many of the charts are pointing to the fact that China is going to become a very big focus of the global growth, the export, the global GDP, and all of that is going to have an impact on United States and also a lot of the developed countries. Within the last few decades, everybody felt more comfortable parking most of their money into the developed countries because we all felt that the safety was there. Now with the change that took place in 2008, it just pretty much shook the confidence of a lot of people. And many investors are looking at where were the risks in 2008. Where we saw the risk in 2008 was really the financial institutions that were on the verge of collapse. And if it wasn't for Federal Reserve stepping in and injecting the liquidity that they did, many of those institutions would have gone under. Now, one of the things that took place that most investors felt comfortable with at the time is now starting to come back, and it's becoming an area of risk for many people to be conscientious of and worried about. For example, in 2008, when the markets went through the massive sell-off, Bernanke stepped in and said, in order to preserve the banks from going under, we're going to lend them the money at the rate of 0.25% and tell these banks that if you want to bring up your liquidity, buy the U.S. Treasury, and that will create a risk-free rate of return in your portfolios. And on top of that, we're going to buy a lot of these bad mortgages from your bank and put it on Federal Reserve's balance sheet. That played beautifully within the last 5 years. Now we are reaching a point that keeping the rates where it's at is not sustainable. We cannot keep rates this low. If rates go up, immediately the value of the bonds are going to drop. And many of these banks are sitting on tremendous amount of bonds. If they dump this bond in the secondary market, we're going to see the value of the bonds go down even more. So it's becoming a catch-22. When Bernanke did that, and at the same time we saw Europe doing the exact same thing, everybody was hoping that GDP was going to pick up. The problem is GDP did not grow domestically and GDP did not grow on a global basis. Now everybody is looking at this balance sheet and saying, so what do we do now? We cannot continue buying mortgages at the rate of $85 billion per month, and we cannot keep interest rates where they're at. So if rates go up, bonds come down further, there's going to be interest rate risk for many of the investors. Inflation risk is another issue. Political risk is another problem. So everybody's looking at the big picture and saying, where would be the safe place to go? This year, in my opinion, the reason why the equity market went up as much as it did, it wasn't because there's anything magnificent happening with any of the companies. It's not because we are seeing massive growth domestically or globally. All of it had to do with the fact that when Bernanke just said that we are thinking of increasing interest rate, the bond market went through the biggest sell-off of historical level in the bond level from month of May all the way till now. We're just starting to see a little bit of stabilization taking place in the bond market, but still all bonds are in the negative for the year. Then we saw that the commodity markets start pulling back because there is no growth. If there is no growth, the commodities are going to go nowhere. Currency market, nobody dares play with that due to the fact that China is right now trading at levels with majority of the emerging markets, especially in India and some of the Middle East, and they're using their currency. So US dollar is starting to lose its value very rapidly, and it's most likely within the next, in my opinion, 5 to 7 years will no longer be the global currency. So the only sector that it's leaving that people can go to and actually make money is going to be on the equity side of it. So if bonds are not making money, commodities not making money, currency is not making money, real estate went dead flat after the month of May when everybody realized that Bernanke is not planning on increasing interest rate and it's a very illiquid asset. There is no reason for investors to park their money in a very illiquid asset that's most likely going to remain flat. And cash is not going to make money for anyone. So all that money came out of those five sectors and poured into the equity market. A lot of cash comes into the ETFs, into a lot of the mutual funds. The managers have no other way to deal with that cash but to buy across the board in everything. And that artificially took the prices of all the stocks to the levels where they're at right now. PE ratios of the majority of the companies are not any longer supporting the value of these stocks. So this euphoria, at some point, it's going to come to an end. In my opinion, going into 2014, it's going to be a very, very critical year for a lot of investors to really protect their portfolios. I don't believe that when Janet comes into the position in 2014, she's going to say that, oh yeah, we are going to continue at $85 billion indefinitely. That's just not going to happen. Interest rates cannot remain at these levels, but then at the same time, if they up it, we would be at the risk of possibility of flipping into a recession. So it's going to be very critical, the language that she will use in order to make sure that the market does not go through a massive sell-off and a panic, just like what we saw in the month of June. Everybody was expecting Bernanke to announce that there's going to be some tapering, and when he came out and he said that there's absolutely no GDP growth and unemployment number is not changing, that changed the landscape for everyone. And that's the reason why we saw stock market go even higher, and everybody felt that this trend is going to continue on for a longer term. Given where we are right now, I feel very strongly that we are going to see very specific countries in the emerging markets that are going to do extremely well going into 2014 and beyond. U.S. market is still going to remain a safe place, but not all asset classes in the equity sector is going to be beneficial for investors to remain in. The more liquid stocks initially are going to see further pullback, but then as markets start stabilizing a little bit and everybody realizes that the world is not coming to an end, we will see those stocks do better than some of the smaller cap, mid cap, or micro cap names. For us, the focus of our portfolios right now is mainly on quality, liquidity. As long as you have quality names and you have liquidity, you would have the ability to hedge the downside of the portfolios if need be, for whatever percentage you need to hedge it. And you also have the ability to put option overlays in order to bring the income in while the market is going through its volatile period. In my opinion, the whole concept of asset allocate and call it good, that's dead. That's out and it's not coming back. If you allocate across the board in all asset classes, you're going to fall behind. Last week I was in New York and I attended a hedge fund conference there where a lot of the pension plan endowments and foundations were talking about their concerns as to what they're seeing with their portfolios. In 2008, when the market melted away, many of them met and thought that, okay, the safe place to be in order for us not to get fired would be to change our investment policies and actually increase our allocations into the alternative products because it will provide some protection on the downside because they hedge the portfolios versus a long-only equity portfolios, and also increase our allocations into the fixed income. Nobody thought longer term at the fact that interest rates cannot remain at these levels, and we have experienced truly a bubble within the last 5 years in the fixed income. So what happened is everybody changed their investment policies, everybody increased their allocations on the fixed income, and the portion that they pulled back on the equities, majority of that did not go into the right buckets. So now, after the month of May and June of this year, everybody's scratching their heads and saying, now what do? We switched our investment policy. We increased our fixed income allocation. Fixed income reversed out all of the gains of this year, and it's now in the negative, and the possibility of it going up within the next 2 to 3 years, slim to none. Interest rates will go up. It's not a matter of if, it's a matter of when. And when interest rates go up, those bonds are going to lose again, and it's going to create more of a deficit in their portfolios when they have to do these payouts. Equity market, there's going to be no way for the growth to be at the level that will support a substantial growth on the equities from where we are right now. At the end of each year, the report card of every country is its GDP growth. If GDP is not growing, at the end of the day, you're just not growing. And that's what the global markets are faced with right now. So given the fact that there's going to be no GDP growth, the possibility of unemployment changing is going to be slim to none. One of the other aspects that most people did not account for, including Federal Reserve and Bernanke, was the fact that you just pouring liquidity into the system is not going to create jobs. Many of the corporations are now looking at their companies, and they're looking at their budgets and their productivity and saying that if I'm able to generate the same level of profit or even higher profit by having the smaller number of employees and getting more productivity out of them and using automation, there's really no need for them to go out and open a new manufacturing plant or to go out and hire more people. So if they're not going to be doing that, we're not going to see a growth anywhere. Unemployment is not going to change. And this phenomena is happening on a global basis. In the past, historically, whether it was US companies or developed European countries going out to emerging markets, or even within the emerging markets, when they would open up manufacturing plants and new companies, many of them were hiring massive number of employees because it was so cheap. Now everybody is realizing that it's better to pay that fee one time and have their manufacturing plants be fully automated using technology and robots than to hire all of these people and have to deal with all of the employment issues, healthcare issues, employment laws, especially if you're a European company or you're a US-based company. The laws that you have to abide by here are the same laws that you would have to abide by if you go into some of the emerging markets. So because of that, everybody's moving more and more and more toward automation. The more they automate, the less there's going to be a need for humans to be working in these manufacturing plants. The more of that we're going to see, unemployment is going to continue to go up. And we're going to have this huge gap between the haves and have-nots. So historically, in the capitalistic market, you have those that have the capital and you have the labor. So the capital will employ the labor. Both sides of the equation benefit from that. Now what we are seeing is with automation, the capitalists have the capital and they're able to basically use automation to improve everything and their balance sheet and their financial returns. And the labor is the one that's suffering here. They don't have the ability to benefit from that. Their basic employment is going to depend on what kind of jobs are going to be available. And as automation continues, we're going to see the blue collar is going to be left behind. And as more and more that's going to happen, we're going to see a major change in the overall developed countries' behavior and employment. And we're going to see it kind of go more toward the emerging market levels, meaning that we are going to have more number of unemployed. You're going to have a big gap between the people that have the capital and the people that don't have the capital. So that brings us back to what sectors are going to do well. Where would be the place to be? So even within the stocks that are available, you're going to see certain stocks that are going to behave substantially better than others. So if you're going to have these two big groups of people who have the capital and the people who don't, you're going to see the higher end sector continue to do extremely well. And then you're going to see the really, really lower end do well. But the middle is going to be where the money is going to be lost due to the fact that there's going to be less middle class across the globe, not just domestically, but across the globe. Now, some emerging markets are going to be seeing increases in the middle class, but not all. And that's where it's going to be very critical as to which countries to pick to have your capital invested in and benefit from that. And the whole concept of the rotation comes in. It's no longer the idea of asset allocate across the board throughout all emerging markets, throughout the developed Europe, as well as across the board in United States, and everything will do well. That concept is gone. It's all about what's good and hot today and participate in that sector. And as soon as you see that that sector is starting to cool down, to take that capital and rotate it to another sector. Within the last couple of years, a prime example, we've seen the developed Europe go up very nicely because of all of the quantitative easing that took place in Europe as well and all the capital that went in. Now we are seeing that as of a couple of days ago, ECB came out and said that we're going to reduce rates. If things are looking rosy, you don't need to reduce rates further. That's because they're not seeing any growth, and they're very concerned that if GDP doesn't pick up and if unemployment doesn't start improving, they will go into a deeper recession. In the United States, same concept. Bernanke came out in his last testimony and said we are at a very, very critical point right now. If we pull back on the quantitative easing, and if we do it too drastically and too quickly, United States would very quickly fall into a recession. And for an economy our size to get out of recession is going to be very difficult. So I feel that the exiting of Bernanke could not have been better. He's going to go down in history looking like a hero. He came in the middle of the crisis, housing meltdown, the financial meltdown, and the engineering that he did with putting the liquidity into the banks through selling them the U.S. Treasury and having them borrow at the rate of 0.25% was flawless. What he didn't account for was the fact that over the last 5 years, we would not see the kind of growth that he had hoped for. And now it's at the point that what do you do now? And he's exiting out and passing it to Janet and saying, you deal with it. I think that job is going to be the worst job on the face of the earth for anyone to have to deal with, and I feel sorry for her because we cannot be doing the same thing that Bernanke did for much longer. Maybe there is room for another year to year and a half, maybe two, but at that point, it's going to hit a very critical level. If you have a situation where the GDP is growing and your debt is growing, that's okay. Not that it's really okay, but it's better than the situation where your debt is growing, but your GDP is going lower and lower every year. That's literally what we have seen within the last 5 years. Now, Bernanke is absolutely right at the fact that it's important to, in situations like that, to pour liquidity in on the hope that you're going to pull out of it. And he's been a student of the recession, and that's the lesson that everybody learned that they should have done differently back in 1929. But things have changed. We're in global markets. Back then, there was that need for the labor, and the capitalists would come in and hire the labor to push the markets up, and employment and middle class growing helped the economies over the last 4 or 5 decades. Now things have changed. We are reaching a point that computers are going to be making even smarter computers. And as that happens, there's going to be no need for human touch or the employment to change. So this is a new era of what we are going to see with unemployment. This is the new norm, and we just need to get used to it. When the credit crisis happened, they changed the unemployment benefits to 99 weeks. Then as of a year and a half ago, they brought it down to 36 weeks, and now it's down to 26 weeks. So after somebody exhausts their 26 weeks, they're not being accounted for anywhere, but they're still unemployed. There are many people that are still unemployed after the 26 weeks. The other aspect of it is many graduates that graduate from universities, they were never part of the workforce. So they never collected unemployment, but they're still unemployed. So if they can't find a job, they're also part of the unemployed pool, but they're not being accounted for and they're not represented in the numbers. So Bernanke is very well aware of the fact that this unemployment number is completely a fake number. And he is thinking longer term that if this trend continues and if GDP doesn't pick up and if companies do not hire and expand, this is going to be a big problem. How do we solve it? I don't know. I think this is a bigger problem that we have to kind of wait and see how it's going to resolve itself. But the risks that are associated with it and the fact that all of us have to be conscientious of how we are going to invest our clients' money is the bigger issue and the bigger problem, I think, across the board for many investors. What I'm seeing in the overall market and how we are positioning ourselves is that we don't want to be a long-only shop. We don't want to be a long-only shop with our equities. We don't want to be a long-only shop with our bonds. We feel that the risk of that is extremely high. in the environment that we are in right now, I'm feeling more bullish toward the China market. I believe that within the last 17 years, China has outgrown all other markets across the globe. And I think given what they have going for them, they're going to still exceed the rest of the world. There's always that risk with regards to the political issues that could come of it. But I think that's something that will not surface within the next 5 to 10 years, in my opinion. It could be sooner, but I seriously doubted that it would be sooner than that. One of the best things that they got going for them is the fact that they have their internal economy and they have their external economy. Most people don't realize that when you have a pool of 1.4 billion people, they still have to eat, they still have to have housing, they still have to have furniture and clothing and all of that. Their internal economy is growing very rapidly. Their external economy slowed, but still is higher than any other country in the world. Their GDP is growing very rapidly. And their new president, when he came into the position in the month of March, in his first presidential speech, he said that during my presidency, my goal would be for China to become the largest economy in the world, and I want China to be the largest component of the global GDP. That's a very big goal. He feels that by year 2023, they will become the #1 economy in the world. If they are able to maintain a 7% GDP growth, compounding that over the next 7 years, it will give them the ability to do that. The other thing that has happened that nobody thought that would happen this quickly was the fact that India, one of the second largest economies, is now trading with China using their currency rather than US dollar. That was a big blow to US. Also, some of the other Middle Eastern countries are now trading with China using their currency. So as more and more countries around the globe continue to trade with China, and China being the biggest exporter in the world, they're going to benefit from that. And at some point, we could be very easily seeing that their currency becomes the world currency. We had the ability and the benefit that US dollar for many, many years has been the global currency. And that gave us the ability to basically print money and hope for the best. Well, hope, as we all know, is no longer a strategy that could be used by Federal Reserve or anyone. So as markets continue to go through these periods, we're going to be more worried about what will happen if our US dollar is no longer the world currency. What happens if the commodities across the globe are not pegged against the US dollar? As that happens, we're going to lose our power very rapidly. And that's the reason why I was pointing to the fact that even within the companies in the United States, we have to be very conscientious of which ones do we pick to invest in and which ones will give us the best risk reward. Many of the companies now are keeping their profits offshore, and they're not bringing it in US, and they're not paying taxes here. So as many of these larger cap names that we always felt were the safe havens continue to trend that direction, and if they're generating most of their income in emerging markets, we just need to be conscientious of which countries are they focusing on, and those would be the type of countries that we would want to have our assets in. Now, if rates continue to be an issue, then we're going to be very worried about what would that do for the portfolios that have heavy amounts of bonds. So I feel that given the current market, this is the best time for reshuffling everything around and looking at things very different than how we did in the past. Historically, we would say we will put X dollar amount in the domestic bonds, X amount in global bonds, a certain amount in commodities, and then we would divvy up the equity bucket into small cap, mid cap, large cap. That has changed. Now we have to look at the bigger picture and say, okay, if we know out of the 6 asset classes, 5 of them could be at jeopardy, where do we want to be? Even with the cash, for me, I always feel that in order to do a good job as far as being able to predict the next 3 months or 1 month or whatever the case might be, was to always listen to every word that came out of Bernanke's mouth. One of the things that he said in his May 31st testimony, literally within the last 7 minutes of his testimony, he came out and very casually said that if the markets were to be faced with another credit crisis equivalent to 2008, it is very important for all financial institutions to have enough reserves of their own to be able to preserve the assets and the liquidity for all of their depositors, because at this point Federal Reserve no longer has the liquidity or ability to backstop the money markets from breaking the buck. That was a very big statement, and he was very casual about it. It took me back to his first testimony of year 2007. On January 9, 2007, in his first testimony of the year, he came out and he said, given where we are in the market, I'm extremely concerned at the fact that real estate is in a bubble, and it's going to be a matter of time before we are going to see a real estate bubble bursting, and as that happens, many of the financial institutions are going to be in trouble due to the fact that they have tremendous amount of subprime mortgages on their balance sheet, and as values drop, they're not going to be able to sustain, and they're going to be at jeopardy. Literally 6 months after that, on July 14th, when the earnings season started, financial institutions start reporting their earnings, and all of them start coming out one after another and saying that they have tremendous amount of subprime mortgages on their balance sheets. Their delinquent loans are going up very rapidly, and if this trend continues, they're going to be in trouble. Week after that, the real estate markets start going through a sell-off, and we all remember what happened in 2008. So in my opinion, Bernanke just does not come out and say something for sake of saying something unless there is data behind it. And he's the one and only man that knows exactly what's going on with the balance sheet of Federal Reserve, and he's the one and only man that knows exactly what's happening with the balance sheet of all of the banks and their reserves. So if he's making that statement, that makes me worried. I much rather have my portfolios and my clients' portfolios be invested in the larger cap quality names than to sit on tremendous amount of cash. Because God forbid, if another crisis of 2008 were to happen and we go into next year, GDP doesn't grow, unemployment does not come down, and the global markets fall into a recession, we are going to be faced with a situation where the banks are not going to be able to sustain at these levels, and it's going to be impossible for Federal Reserve or ECB to continue buying mortgages indefinitely from them. It's just not going to happen. As that happens, many of the banks are going to be in trouble again, and I can guarantee you that there's not going to be one financial institution that has enough reserve to backstop the money markets of their banks or their financial institutions, and that's the point that it's going to be dangerous. So the risks have changed drastically. The risks are no longer the kind of risk that we used to see before. We have to be worried about how much cash are we sitting on. We have to be worried that when rates go up and those bonds drop even further, what will happen to those portfolios? We have to be worried about the companies that we are investing in, how much of their revenue is being generated domestically, how much of it is being generated on a global basis, and if it's coming from global basis, which countries. Some of the countries that historically nobody ever paid attention to, and it wasn't really a focus within the emerging markets, was, for example, South Africa. Now South Africa is doing actually better than some of the other emerging markets that historically did phenomenally well, such as Mexico or Brazil or Chile and those type of countries. Now we are looking at where can we hide the cash so we are not sitting on a lot of cash and going through the jeopardy of the buck breaking and there goes your money. I'd much rather call my clients up and say, Mr. Smith, here's a certificate of Google and Apple and Microsoft and Johnson & Johnson, than to call them up and say, gee whiz, I was trying to protect you and I was sitting on tremendous amount of cash and money markets broke the buck and there went your money. It's not going to be a pleasant conversation. So for us, we are looking longer term. In year 2014, what are the political risks? What are the interest rate risks? What are the inflation risks? All of those things go into putting a portfolio together. I am extremely bullish on China. I feel that China is going to do substantially better than the rest of the world. So that's the area that we are heavily invested in, and we have benefited very nicely since 2008. Even with the meltdown of 2008, we did extremely well in that market, and I think it's one of the markets that everybody should have a participation in. And then within the emerging market, it's important to look at the countries that we never paid attention to, such as South Africa. That market is changing very drastically. And in U.S., for us, our portfolios right now, I'm shying away. We pretty much within the last couple of weeks exited out of all of our small cap, mid cap, micro cap names. We are 100% large cap, S&P 100, S&P 500. I'm prepared that if we go into tail end of this year, if the talk of tapering starts coming back up again, if we start seeing the possibility of interest rates going up, at that point we would be ready to be able to take the portfolio more liquid or hedge the heck out of it if need be. I do not believe going into the January of 2014 we're going to be seeing a smooth ride and continuation of this euphoria. Several things will come to a head in month of January. Janet is going to be stepping in, and every word that will be coming out of her mouth is going to be important. She will be setting the tone as to what 2014 and beyond is going to look like. Being a vice chairwoman is kind of like being a vice president. Until the president dies, you're never going to know what the policies of that vice president is. So we don't know what exactly her policies are going to look like. If she comes out with a very neutral language, we're going to see more stabilization into the first quarter, and also the earning reports that are coming out are not very strong right now. So the fourth quarter earnings, we already know, are not going to be very strong for many of the companies, and the forecast that they're putting out is not very strong. So we're going to go into January. The second week of January, earnings season would start. We're also faced again with the debt ceiling issue. We're going to be faced again with the possibility of government shutdown and a brand new vice chairman coming in, or a brand new Federal Reserve chairman coming into a position, not knowing what her policies are going to be. So the overall risk on all levels are going to be very high into the month of January. Now, we all know that the government cannot stay shut forever, so even if they shut it down, they will open it back up again. So there will be a sell-off from that, followed by a rally. We know that there's no other way but to increase the debt ceiling. The chances of Congress being able to come to a decision and do any kind of cutting of the budget is slim to none. They can't agree on anything, and literally between now and end of the year, they're going to be in session only for 2 more weeks. The rest of it, they're off. So in 2 weeks, there's no way that they're going to come to a decision on anything. So comes the 12th hour again, just like past, they're going to increase the debt ceiling because this is the money that we already spent. We don't have an option but to pay our bills, so they're going to up that. So initially, we're going to see a sell-off because of the nervousness, followed by a rally with that. And once Janet comes out and gives the indication of what her policies are going to be, we will see either a rally or a sell-off. At this point, it's 50-50. So for us, we've made a very nice gain in our portfolios. We're not going to leave that on the table and watch it all wash away, depending on what happens. So we will be taking tremendous amount of profit off table toward the tail end of the year and go into the beginning of next year in a very neutral position, prepared to hedge if need be further in order to preserve the assets. On our bonds, we reduced our bond position drastically in the month of April before the market sell-off took place. And any bonds that we are holding is purely investment-grade corporates that are between 3 to 5 years, nothing longer than 5 years, and also high-quality municipalities on a very limited basis. We have less than 2% of our portfolio in that. And even with that, we are not going to leave it as a long only. If need be, we have already communicated to all of our clients that we will be hedging our book going into 2014, and above and beyond that, we will be doing an option overlay on all of those portfolios in order to enhance the returns, because there's going to be no appreciation of the bonds. So if you're just going to be collecting the coupon on that, we might as well increase that return by having an option overlay on it, or hedge it to the downside. So if market were to go through another leg down on the bonds, we're able to benefit from it. So that's how we are positioned. I strongly feel that investors have to be a lot smarter about their money than they have been in the past. It's amazing to me how many people I talk to on a regular basis that when you talk about what happened in 2008 and first quarter of 2009, they kind of look at you and they go, "What are you talking about? What happened?" I'm like, "Are you kidding me? We saw the biggest sell-off ever and you already forgotten." So it's a magnificent thing that humans have an ability to only remember the good and the short term and forget the bad. That's magnificent for our business. Otherwise, nobody would ever invest in anything. So I feel very blessed about that aspect of it. But at the same time, it's very difficult when you have to explain to people that that happened, it was real, and it can happen again. Now, the main difference is in 2008, when that sell-off took place, we saw the market rebounding back and actually going higher than the lows of 2008. Now, that didn't happen because of the global growth or the domestic growth or the companies are doing phenomenally well. All of that happened because Federal Reserve poured huge amounts of liquidity into the system. Now they don't have that ability anymore. If we go through another sell-off, whether it's equivalent of a 2008, less than 2008, doesn't matter. The fact of the matter is that there is not such liquidity available for the government to be able to preserve the economy from going into a recession. And if that's the case, you're not going to see the kind of rebound that we did from 2009 till now. So if that's the case, your portfolios need to be hedged. Your portfolios need to be protected. And what worked in the past is definitely not going to work again. So that's how we are viewing the market. That's how we are viewing the emerging markets, as well as the risk. The risk that used to be very different, how we thought about things, have shifted, and our focus has shifted with that. And I believe it's important for everybody to be more conscientious of those things and actively talk to their clients and say, this is the new reality. In the past, we used to go in the bonds, hide in the bonds. It was a great place to be. Nobody worried about anything. We can't do that anymore because the bonds could lose you even more than being in the equity side of it. The beauty of it with the equity side is the fact that if you're in it, I always explain to my clients, it's like owning the best rental property in the greatest neighborhood. Your rent is coming in every month, but the value of your rental property would go up and down depending on what's going on. And if that's happening, you just don't sell your rental this month, buy it back the following month. You just stay with it and keep on collecting your rental income. And when the real estate market comes back, so goes the value of your real estate up. Owning the largest cap, really good quality blue chip names that pay you a dividend, same concept. At the end of the day, I don't have to worry about Microsoft and Johnson & Johnson and Coca-Cola closing their doors and going away. The value of the stock can easily drop by 80%. But that dividend is coming in. It might get reduced. It might stop. But the company is not going to go under. And that's the reason why we feel very adamant about not holding anything that could have liquidity issues associated with it. And that's the reason why we took all of our gain off table already. So we are not holding any small cap, mid cap, micro cap names at all for the remainder of this year or going into the first part of next year. So I know it was a lot of information, but I'll open it up for any specific questions. Yes? Mm-hmm. Mm-hmm. Correct. That is absolutely correct. But the problem did not go away. And she can say all that she wants. At the end of the day, there's a limit to everything. It's not an endless pool of capital that they would be able to inject into the market. So it will reach a point, and that's the reason why I said the language that she uses in her first testimony will set the tone of whether the market is going to believe her or if the market is not going to believe her. I can tell you that I'm 6 foot tall, but at the end of the day, I'm not. So I can wear a high heel and look tall, but that's a perception that I'm creating. It's far from the reality of it. So yes, they have injected capital into the market. They can continue to do that, and I believe that they can easily push it into the 2015. But this party will come to an end. It's not something that can go on forever. And that's the reason it's important to kind of look further out and say, where do I need to be in order to preserve my capital? And that's where my fear is. Interest rates will go up. It's not a matter of if, it's a matter of when. When that happens, bond market will take another leg down. If companies are not going to hire for sake of hiring because it's the right thing to do, then we're not going to see unemployment change. If anything, in my opinion, the global unemployment is going to get worse rather than better. Automation is going to eliminate many more jobs. And as that happens, we're going to see a bigger gap in emerging markets as well as the developed markets, in the haves and have-nots. So all of those things are risk to me. So Janet can say whatever she wants, ECB can say whatever they want. The reality does not change. If GDP goes this direction and debt goes this direction, this gap is a danger zone for me, and it's a bubble. It will burst. When it will burst, that I don't know. But if we see it reversing, and if we see unemployment improve, if we see GDP improve, then that would be a different story. But until that happens, I don't buy into it. I'm just not going to risk my capital on the hope process. It's not going to happen immediately. I have a feeling that there's a very high possibility that Janet is going to come out and say that all the way through the tail end of 2014, she's going to keep interest rates where they're at because she cannot afford having the bond market go through another massive sell-off. We are already seeing all the major bond funds, such as PIMCO and Vanguard and all of them, they're seeing billions of dollars come out every single month, and that money is flowing artificially into the equity market. That's very dangerous. And most people don't even realize that the bond market is much larger than the equity market. So if that imbalance gets bigger and bigger and bigger, that becomes even a bigger problem for her to deal with. So she will use a language to calm the bond market down. So I don't think she's going to up it, but it will have to happen. It will have to happen. You just cannot afford keeping at these levels. Not all of them, not all of them, but at the same time, you have to look at the bigger picture. You need to have a consumer buying your product. You can be the best company on the face of the earth, but if people are not buying your product, your company is going to go nowhere. So yes, you have reduced your expenses substantially. You're sitting on pile of cash. You have no debt. So if you're looking at your balance sheet, you're looking pretty. But at the end of the day, somebody has to buy your product. And if global GDP is not growing, then you're going to be in trouble. In general, you're going to be in trouble. It doesn't matter how good your balance sheet looks like, and that's the concern that we are thinking of. You're absolutely correct on that. But how much more can you push something up artificially? That's the problem. Does that answer your question? Historically, but historically we did not have the unemployment problem. Historically, we did not have the liquidity problem. Historically, we did not worry about the global growth. All of that has changed, and that's why in the second to the last page we talk about the risk, different risks. The risks have changed, and that's why our outlook on where we want to be and the overall investments have changed drastically. I'm not worried about Coca-Cola. I'm not worried about Microsoft. What I'm worried about is if everything does not go up, then they will be in trouble. They will be. People have to have money to buy Coke. People have to have money to upgrade their software. If they don't have money, no matter how cheap those companies' stocks are, they're just not going to go any higher. And that's the problem. It will impact everyone. It's just that the risk, the way that we used to think about it, has changed so drastically because we were never faced with the things that we are faced with today. We never used to worry about bonds. We never did. It was always perceived as the safest place to be. We never worried about the government not being able to pay their debt. We were worried about that. So that's one of the reasons why I'm saying the risk factors have changed, which impacts the stock market. It will impact the investment mentality in general. What other questions? Yes, sir.
What's your outlook for PM prices, in particular some of the countries you mentioned that have long-standing fiscals,
I've
outflows and good things?
Yeah, I'm personally not a fan of currency trading whatsoever. I never understood it. I would be the first one to admit. I never touched it. I never understood it. I just feel that it goes up and down artificially. And within the, especially last 10 to 15 years, literally, I don't know of any currency trader that has lasted more than 4 years. Because if they start doing well and they get on the radar, literally George Soros takes the other side of the trade and they're gone. They're history. So I would not be one that would be able to comment on that very knowledgeably because I don't understand it.
You guys don't tend to
No, we don't. We don't. Because at this point, where do you go? I'm very bullish with regards to the fact that China's currency could become the world currency, but is it the next 5 years to 10 years? I don't know. So at this point, I'm more worried about my risk going to 2014 than to want to hedge that for the next 10 years. It's all about what's happening right now for me, because the overall landscape has changed so drastically, and it will continue to change drastically. Nobody would have ever thought that India will be trading with China using their currency, or some of the other um, Middle Middle East countries would be trading with China using their currency, but they have. So if that trend continues to go up higher, then that will become something that I will worry about. But even for us, we have a China fund that we manage. We're not hedging their currency there either. Everything is in US dollars. Yes, sir. Oh, absolutely. Absolutely. So you're absolutely correct on that. We manage a China fund, and my managers are Chinese. They live in mainland China and they trade in mainland China, but none of them believe in their own banking system. So we do not buy anything that has to do with the banks or insurance companies at all. And we feel that for the next 5 to possibly even 10 years, it would be extremely foolish to invest in those sectors because none of their books are real. The one thing that I have to give the new president of China credit for is within the first week that he stepped into the job, I don't know if you recall, in the month of March, there was a massive sell-off that took place in the mainland China. In a matter of 1 week, the interbank rate went from 0.25 to 7.95. Their market dropped in 5 trading days, 17% in a matter of 5 days. He put the message out to all of the bankers saying that in order for the rest of the world to trust us, to invest with us, to want to do more with us, we need to get rid of the shadow banking. And as long as we have those problems, the rest of the world will not take us seriously. So he's really cracking the whip and trying to whip things into shape. Is it going to happen within the next year, 2 years, 3 years? I don't think so. It's going to be a longer term, but they're taking all the right steps toward that. If you're going to be the #1 economy in the world, you better have books and records that everybody's going to trust and they would want to invest with you. So I think they're moving in the right direction, but it's not going to happen overnight. It's interesting, since I'm so bullish on China and I always talk about China, I always get prospects that ask me the question, but have you saw this article or did you see that 60-minute deal that came out that showed all of these properties that were built in mainland China and they're all sitting empties, and all these cities that they built on the hope that people would come, and that hasn't happened. And I always have to tell them that now you have to look at it on the other side of the coin and see what they're not telling you. Yes, that is correct. There's a tremendous amount of real estate that's sitting there vacant, but many of the investors that invested came to China and invested in China. They're not Chinese people. A lot of them came from Hong Kong, from Japan, and other parts of Asia. They saw this great opportunity and they felt like, build it and they will come. Well, they built it, but they didn't come because the global market went through a massive slowdown since 2008. Well, what had happened was the government waited until many of these builders and developers were on the verge of bankruptcy or did go bankrupt, and they ended up buying these properties pennies on a dollar from these developers. Now, if you're a villager and they want to build a highway that goes through your farm, then what they do is they come to you, instead of paying you cash, they say, here's the key to an apartment in the city. Now you can go live in the city, use one of the rooms and rent the rest of it and don't even have to work, and the value of your property is going to go higher and you don't have to even worry about anything. The villager that had the farmland that they were living off of is benefiting from, and the government ended up buying properties pennies on a dollar and achieving what they want to achieve. That's the other side of the coin that you will never hear about unless you have somebody that's from mainland China who understands what's happening in that market. Personally, I would never, ever, ever put a large portion of my money or any of my investors' money with the manager, whether it's a mutual fund or an ETF or anything for that matter, if the manager is sitting in San Francisco or New York or Chicago trading Mexico and Brazil and China and other emerging markets, you have to be from that country. You have to understand what's happening and have your pulse on the market to know what areas are the benefit for the longer term and short term and what areas of our risk that you should not be touching. When the meltdown happened of the financials, we did not have a dime in it and we didn't care what happened. All of our money that we have invested in mainland China, I'm long only. The benchmark is down for the year. I'm up 17% for the year in mainland China. Why? Because I'm 80% invested in anything that is healthcare related and pharmaceuticals, because that's the area that is growing rapidly. And when you have 1.4 billion people, and with the pollution issues that they have, they're getting sick and they're getting cancer and they're dying. So they need the healthcare money. So the government is spending money there. And the other 20% of my money is invested in the companies that purely deal with water pollution and air pollution. And that's another area where the government is pouring tremendous amount of money and they cannot back off on it for many more years to come. So I'm holding a long-only portfolio and making money when everybody else is losing money. Now with the ETF, it's purely hot money. When everybody's all excited and somebody gets on their soapbox saying that the world is looking great, ton of money goes into that ETF and artificially pushes it up. Then 60 Minutes airs something and says the world is coming to an end, China's going to fall off the earth, then everybody sells out of that ETF and it artificially goes down. It has absolutely nothing to do with the reality of what's happening in mainland China. So I'm not a believer in that at all. That's why I say that it's important to understand exactly what you're owning, what the risk of the asset it is that you're owning, and know when to be in it and when to be out of it. So I'm in China, but I'm not invested in the banks, and I'm not at risk at all, regardless of what happens. Absolutely. It's not going to be a near future type of a thing, but is it a high possibility? Yes, I will put it in the bucket of a high possibility. I don't think it's going to be anything that I need to worry about today or tomorrow or for the next 5 years, but 5 years from now, my outlook could very definitely change and say it might be another year or two out. I would have never in my wildest dreams thought that they would grow at the rate that they did. Just to give you a feel, 5 years ago when I went to China to start my China fund, in the city of Shenzhen, which is 45-minute drive from Hong Kong, the population of that city was 720,000 people. Today, it's 7.9 million people in 5 years. So things change very rapidly. Another statistic that hit me hard when I saw it, and I felt bad. I live here, I make my money in this country, and I was an immigrant. I feel that this country was always perceived as the land of opportunity, but we're looking at every year, United States puts out a total of 46,000 engineers, and we look at China, they're putting out 436,000 engineers per year. How on earth are we going to be able to compete with that? It's impossible. Several years ago, everybody said, oh, if they build cars, who's going to buy it? From safety issues, nobody's going to buy it. Now you go to a lot of the Middle Eastern countries, you go to a lot of the emerging market countries, and you see a lot of Chinese cars. A few years, everybody used to say, who would buy their drugs? India used to be, for the longest time, the biggest exporter of generic drugs. As of 2 years ago, China took over that market. So don't underestimate them. One of the main differences between China and some of the rest of the world is that they're a communist nation. So they have ability to do things that the rest of the world cannot do. They play by their own rules. So I kind of always explain it in a way that they're like a submarine. By the time they come above water, the damage is already done. And everyone's like, whoa, what happened here? So we have a lot of catching up to do, and that's what concerns me. So with regards to the currency, do I think it's going to be the next 5 years? Danger? Absolutely not. But could it be the next 10 years or the next 20 years? Absolutely it could be. And it could be another country, not necessarily just China. But if we keep on doing what we're doing, I mean, this is just not going to work. It's simple math. You cannot have a GDP going down and your debt going up and just hoping for the best. That's my biggest concern, is that I just don't see our politicians really doing anything about it. I was really embarrassed, to say the least, about what literally took place in our country last month. We just acted like a bunch of kids. Kindergartners don't even act the way that our Congress did. If Republicans have a good idea, Democrats shut it down. If Democrats have a good idea, Republicans shut it down. It's just, let's go against each other just for the sake of going against each other. We can't have an economy grow. We cannot have policies that will make us look like leaders if we behave like that, while the rest of the world is eating our cake and some. So that's what's concerning me. The chances of that, in my opinion, would be very little. The way that they operate is they make changes, and by the time the rest of the world kind of knows about it, it's going to be a long time after they made the changes. It's really not to their incentive to make it look rosy over there, because it's better for them to make the changes, continue to improve their economy, continue to negotiate with all the countries to be doing trade with them in their currency, and for us to think that, oh, who's going to take them serious? And by the time that we all wake up and realize that everybody around the world has taken them serious, we're the ones that have been left behind. So they're not one that will talk about their success that much. And it's not to their benefit to really be talking about their reform and saying, oh, look what we've done. The only thing with the banks is no economy, and I mean no economy in the world, can ever operate without the basis of the financial sector. Me and you cannot survive if there's no bank. We have to pay our mortgage. We have to be able to, go get cash and be able to function, pay our Visa bills or whatever else we do. So the financial sector is very key. The reason why he did what he did within the first week was to put the message out to the rest of the world that I mean business. I'm going to clean house. The same way that because of the briberies that were taking place at the high level, they prosecuted so many people. And he's saying that I'm going to clean house. It's just going to take time. It's a huge ship to turn around, and it's not going to happen overnight. But at least they're trying. I just hope that we do the same thing here. Think about how are we going to create jobs, how are we going to reduce debt, how are we going to make sure that our financial system doesn't go through a major pullback or fall into a recession. Any other questions? Well, thank you very much. I really appreciate everyone's time. My contact information is on the last page. If there are further questions, feel free to call or email me anytime. I appreciate everybody's time.